Saudi Arabia just made its biggest oil price cut in 26 years. On 6 July, state-owned Saudi Aramco cut the official selling price of its flagship Arab Light crude to Asian buyers by $11 a barrel for August deliveries. That takes the price to a $1.50 premium over the Oman-Dubai benchmark, down from a $9.50 premium in July. Aramco also cut prices for Europe and the US, down $15 per barrel for Northwest Europe and $8 per barrel for North America. Two forces are driving this. First, the US-Iran ceasefire in mid-June ended the conflict that had disrupted traffic through the Strait of Hormuz, the passage that carries about a fifth of the world's oil. With Hormuz reopened, Saudi exports have climbed back to near pre-war levels, and the UAE, which exited OPEC during the conflict, has resumed its flows too. Second, OPEC Plus, led by Saudi Arabia and Russia, approved another output increase of 188,000 barrels a day from August, on top of similar hikes in June and July. The result? Brent crude has fallen to around $72 a barrel. That's roughly the same level it was at in late February, before the Israel-Iran conflict began, meaning the entire war risk premium built into oil prices over the last several months has been erased. For India, the direct exposure is significant. Saudi Arabia is India's third largest crude supplier, making a little above 16% of India's oil imports by value in January-March quarter, worth $2.59 billion. Russia remains the largest supplier at roughly 50% of India's total imports. Since this is a broad-based global price fall, not a Saudi-specific discount, it lowers input cost across India's crude basket regardless of which country supplies the barrel. Now, where this money actually goes first is the government's balance sheet, not the pump. The central government has already absorbed over 1.2 lakh crore rupees in tax cuts and other support extended to oil marketing companies during the high-rise period. Against that, only 12,000 crore rupees was budgeted for LPG subsidy this fiscal year, a figure now expected to run at least 3 times higher. Oil marketing companies like Indian Oil, HPCL and BPCL had been selling petrol, diesel and LPG cylinders below cost to hold retail prices steady during the war-driven price spike, and are still sitting on losses from the June quarter, with the effect of costlier crude inventory carrying into the September quarter as well. ICICI Securities also flagged that OMC earnings could change materially over the next 12 months if crude stays at these lower levels. The market is already reacting through OMC stock prices. HPCL closed at 400 rupees, that is up 7% over the past month, but still down 20% year to date. BPCL, on the other hand, closed at 308 rupees, up about 8% over the past month, but still down 19% year to date. Indian Oil Corporation closed at around 142 rupees, up 0.3% on the day, up 5% over the month, but down 15% year to date. Union Petroleum Minister Hardeep Singh Puri recently stated that the government would let international oil prices stabilize for a few weeks before considering any reduction in retail petrol and diesel prices. He noted that Indian refiners are still processing higher cost crude purchased earlier, and any meaningful relief at the pump would depend on sustained lower crude prices over the coming weeks. Many experts also believe that with the nationwide rollout of E20 petrol facing consumer complaints about reduced mileage and potential vehicle performance issues, particularly in older cars, the government may be inclined to offset some of this dissatisfaction by eventually lowering fuel prices once OMC losses are adequately recovered and global prices remain stable. Now here's the full picture put together. Global crude is genuinely cheaper now, driven by the Hormuz reopening and OPEC Plus pumping more supply, not a one-off Saudi discount. For India, this eases the import bill and gives the government room to control its subsidy overshoot and gives OMCs a path to recover accumulated losses. It does not automatically mean cheaper petrol, diesel or LPG for consumers in the near term. That depends on how much of the OMC loss recovery is complete and on a government pricing decision that hasn't yet been made.